Every single year, you need to decide whether it's better for you to save up pre-tax or save up Roth or do a combination of both. Every year, you've got to make that decision. I've got easy, 2 clear examples, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. When you're saving up for retirement, you really have 2 choices. And I'm not talking about 2 choices on how to invest those dollars. That comes later. That choice comes later. Your first choice is, do you want to save up pre-tax or do you want to save up Roth or after-tax? Pre-tax, obviously, as you make your contribution, that money is deducted from your taxes this year. It's deducted from your paycheck, or if you're contributing to a pre-tax IRA, it's deducted on the front page of your tax return. And therefore, the money that you contribute is a deduction on your return, and you don't pay tax on that money this year. It then grows tax sheltered in your account, goes up and down, as you know. And then when you draw that money out, whether it's the growth or your contribution out there after age 59 and a half, then that's when that money becomes taxable. And not all of it at once, but just whatever you drew out that year during that calendar year, that's what lands on your tax return as ordinary income. So you win with this pre-tax contribution if you're in a high tax bracket when you make the contribution and a low tax bracket when you draw the dollars out. That will happen to many of us because you're in a higher tax bracket while you're working, likely because of how much income you have compared to the tax bracket you're in retirement. So that's pre-tax. In the mid-90s, they developed the Roth, and now we've got Rothification going on, where not only is there Roth IRAs, but there's Roth 401ks, there's Roth catch-up contributions, there's Roth simple IRAs coming on board. So lots of Roth because I think it makes a lot of sense for many of us, and also the government needs tax money today. And therefore, when you make your Roth contribution, it is not a deduction. So if you make $100,000 and you put 10 into a Roth, your Roth 401k, you still pay tax on $100,000. Okay, even though 10 of it you deferred into your Roth 401k. So it does not help you on your taxes today. That money grows tax sheltered. Yes, goes up and down. I know that. And then when you withdraw the money, the money that you contributed, you never deducted. So you pull that out and it's not taxable. But then you pull the growth out and the growth comes out tax-free. You don't have to pay tax on that either, as long as you've held a Roth IRA for 5 years and you're 59 and a half. And so you win with that one if you're in a low tax bracket today and a high tax bracket in the future. It's rare, but a lot of people like this approach. I personally do, because we don't know what tax rates are going to be in the future, and you don't know if they're going to create new taxes in the future like they've been doing for the past 20 years. The IRA or Roth IRA. Now, some folks on the radio, financial people on the radio, some financial advisors that don't do planning, okay? They typically really promote one of these. And if they're going to, it's going to be the Roth. If you listen to anyone, any financial professional that's got a big microphone, it's going to sound like you're foolish if you don't use the Roth IRA. I love the Roth. I absolutely do. However, it's not one size fits all. And I would even argue you've got to make the decision every single year which one is better for you. Now, if there's not much changing in your financial life, then maybe the decision is the same every year. But don't fall asleep at the switch, because each year you could have some changes and you're going to want to make this decision. I've got 2 glaring examples where it switched this year and it made a big impact. All right, let's first start with the IRA. Okay, so I've got serving a couple. They've been working and then they've been saving into their pre-tax 401k, and they've been maximizing their Roth IRAs. Makes a ton of sense, okay? That's what they've been doing throughout their working career. Well, last year he retired in August, okay? So what that means is he had most of a full year's worth of income, and because of his role at his company, they actually gave him a sweetener in retirement as he retired, a $50,000 bonus. This guy, he spent his entire career there. It's extremely valuable at his company. And so he actually made a little bit more than normal, even though he worked just partway through the year. And then, of course, in August, he turned on Social Security. So last year, the tax return was a little bit more complicated and surprisingly had a little bit higher income. Now, for this year, when we're looking at things, they're going to be in the 12% tax bracket. Between Social Security and what they're drawing out from their IRAs and their situation, they're going to be in the 12% tax bracket. And when I project that out, they're going to be in the 12% tax bracket for as long as we can see. And if they change it from 12% to 15%, they'll be in that tax bracket for as long as we could see. Could something change? Sure. But that's what it looks like. Well, when we're looking last year, their income was high enough that they actually had $2,300. They were $2,300 into the 22% tax bracket, right? So when we look at all their income minus his pre-tax 401k, minus their standard deduction and any other deductions, then they were actually $2,300, just a little bit, into the 22% tax bracket. So they went to, all right, it's time to make our Roth IRA contributions this year. And I said, hey, not so fast. Look at, and I showed them, and I said, let's put $2,300 into an IRA, into a pre-tax IRA. You're eligible to do it. She's eligible to do it. She wasn't working. So put $2,300 into a pre-tax IRA. That gets you out of the 22% tax bracket. You won't have any dollars being taxed at 22%. And the rest of your contributions, each person can do up to $7,000 into an IRA or Roth or a combination of the two, but up to a limit of $7,000. Let's do the remaining amount into the Roth IRA for her, and let's do yours completely into the Roth IRA. And therefore, we avoided the 22% tax bracket this year, and moving forward, we'll be pulling those dollars out, those pre-tax dollars out, in the 12% tax bracket, likely, right, in those tax brackets. So instead of the automatic, well, it's time to do our Roths, you've got to take a look and say, does it make sense to do any pre-tax? All right, now the opposite, the Roth IRA. I've got some individuals, they're both self-employed. He runs a small business, and I mean small. The revenue, total revenue for the business is about $1 million. He's got a handful of employees, and he pays himself a salary of around $45,000. And then there's usually profits of somewhere between 40 to 60 each year. So all in, he'll maybe make $100,000. And then she is self-employed as well. It's not her own business. She's a hairstylist and makes about $25,000 a year. It's all self-employed income. So between that 100 plus or so and her income, they get a little rent as well. They don't have any retirement accounts. And therefore, we've been maximizing their IRAs every single year because we need that tax deduction. Oftentimes, because of the profits of his business, the rent and so on, they're typically into the 22% tax bracket. So automatically, I mean, we're going to take a look every year. That's the point of this video. But typically, we're going to be doing pre-tax IRAs as we project out. I think they're going to be in the lower tax bracket out there in the future. So we've been doing pre-tax IRAs. All right. Well, all of a sudden this year, and last year as we were meeting, he said, "Gosh, things are tight. It's harder to pass these higher prices on to customers. I'm trying to do it as quickly as possible, but the people that I'm getting my supplies from, my vendors, they're increasing their prices significantly. I'm doing my best to pass that increase on to customers, but it's more challenging, and therefore things are getting pinched." And so we're aware of that and so on. Well, we get the taxes done this year, and instead of having a profit of between 40 and 60 or 40 and 80, he had a loss on his business because the cost of goods sold were significantly higher compared to the revenue. That meant his gross profit was significantly smaller. Subtracted all of the overhead expenses, which were pretty much the same, although increased salaries, he had a loss. This was a complete surprise. So when we look, they were in the 12% tax bracket. And so much so that we shouldn't do pre-tax IRA contributions. We should maximize the Roth IRA. Plus, further, I was prepared and I said, listen, I know it was a rough year. If you're not able to save in retirement, that's okay, but I want you guys to at least do $2,000 each into Roth IRAs because your income is so low this year that you're eligible for the retirement savers credit. So you're going to get a tax credit just for saving up into retirement anyway, even if you're doing Roth. As long as each of you do $2,000, you'll get the maximum retirement savers credit. And thankfully, as you'd expect, due to all the coaching and everything, they said, you know what, cash flow has been tight, but we've been setting this money aside to make these retirement contributions. We've just been waiting for you to tell us whether to do pre-tax or Roth. So we're going to make the full maximum contribution amount. And we did that to the Roth for the first time in several years, simply because their tax picture was reduced this year. Is your decision on autopilot? If you're just contributing to your 401k, maybe you made a decision long ago that that money's going to be pre-tax, and really you've got to take a look at your tax picture and say, well, actually some of that should be Roth or all of it should be Roth, or vice versa. The point is you've got to make a proactive decision and don't put it on autopilot. Work with your certified financial planner. See if you're contributing to the right type of account for tax planning purposes, and if you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com, that's Korhorn with K. wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go on and take your next wise step in your financial life.